Welcome to the Training for Volunteer Income Tax Assistance, also known as VITA, Session 12, What's New for Tax Year 2025. This training is presented by the Franchise Tax Board's VITA trainers. Hi, I'm Tom.
And I'm Trudy.
The Franchise Tax Board is proud to offer this training series for the upcoming filing season. We have created these training videos with California VITA volunteers in mind. This is the 12th of 13 sessions, and we hope you'll find them helpful as you work on your VITA certification.
If you have any questions, please contact your local VITA coordinator. You may also reach out to FTB's VITA team at 800-522-5665 or by email at volunteercoordinator@ftb.ca.gov.
Okay, let's get started. In this session, we will cover the tax year 2025 tax law changes and updates for the 2026 filing season. In particular, we will highlight new tax law changes that may affect the taxpayer's income, itemized deductions, and credits received for the 2025 tax year for both federal and state. The federal health care penalty will remain at $0 for the 2025 tax year. California does not conform. The Foster Youth Tax Credit. The maximum amount allowable for the Foster Youth Tax Credit in 2025 is $1,189. The credit starts to phase out as earned income exceeds the threshold amount of $27,425, and it completely phases out at $32,901. Beginning January 1st, 2024, the law prohibits offsetting delinquent accounts, except for the non-payment of child or family support against the personal income tax refund of an individual who receives the foster youth tax credit. The Young Child Tax Credit. The maximum amount of credit allowable for the tax year 2025 is $1,189. The credit starts to phase out as earned income exceeds the threshold amount of $27,425, and it completely phases out at $32,901. For individuals with no earned income, there is a cap set on net losses of $35,640. Beginning January 1st, 2024, the law prohibits offsetting delinquent accounts, except for the non-payment of child or family support, against the personal income tax refund of an individual who receives the Young Child Tax Credit. The Renter's Tax Credit. This is a non-refundable credit of $60 for single filers and $120 for joint filers. The AGI limit for the 2025 tax year increased to $53,994 or less for filing status single and $107,987 or less for joint filers. The Earned Income Tax Credit. The federal investment income limit to claim the EITC is $11,950 for taxable year 2025. California does not conform. California's investment income threshold is $4,814.
The One Big Beautiful Bill Act, OBBA, was signed into law on July 4, 2025, introducing both permanent and temporary changes to federal law. The following slides highlight some of the key changes affecting the 2025 tax year. Personal exemption credit. The new bill permanently eliminated the personal exemption tax deduction. However, it established an enhanced tax deduction of up to $6,000 for taxpayers who are 65 years or older. This deduction applies only for the tax years 2025 through 2028 and begins to phase out as the modified adjusted gross income exceeds $75,000 or $150,000 for joint filers. The bill also permanently eliminated the itemized deduction for the miscellaneous expenses. California does not conform. Child tax credit. The federal child tax credit increased to a maximum amount of $2,200 per qualifying child. Additionally, the identification requirements for claiming the credit have been expanded. Starting in tax year 2025, the taxpayers must provide a work-eligible Social Security number on their tax return. For joint filers, an SSN must be provided for either the taxpayer or the spouse, as well as for each qualifying child to claim the credit. Mortgage interest. The new bill permanently set the limit on the itemized deduction for home mortgage interest at $750,000 of mortgage debt. It also allows certain mortgage interest premiums to be included as part of the itemized deduction for mortgage interest. California does not conform. SALT deductions. The deduction cap for the state and local taxes, also known as SALT, is set to increase to $40,000 for the tax year 2025 and will rise by 1% annually through 2029. In 2030, the SALT deduction cap will revert to $10,000. California does not conform.
Deduction for qualified tip income. The OBBA introduces a new deduction of up to $25,000 for qualified tip income for the taxable years 2025 through 2028. This deduction begins to phase out when the modified adjusted gross income exceeds $150,000 for single filers or $300,000 for joint filers. To qualify, individuals must provide a work-eligible Social Security number on their tax return. Self-employed individuals engaged in a specified service trade or business as defined under Section 199A are not eligible for this deduction. California does not conform. Deduction of qualified overtime compensation. The bill also introduces another new deduction for the taxable years 2025 through 2028 for the qualified overtime compensation. Single filers can deduct up to $12,500, while joint filers can deduct up to $25,000 of qualified overtime income. This deduction phases out when the modified adjusted gross income exceeds $150,000 for single filers or $300,000 for joint filers. To be eligible for this deduction, individuals must provide a work-eligible Social Security number on their tax return. California does not conform.
Deduction of car loan interest. For taxable years 2025 through 2028, car buyers may claim an above-the-line deduction up to $10,000 annually for interest paid on car loans. To qualify, the vehicle must be assembled in the United States. The loan must be originated after December 31st, 2024. The vehicle can be a car, pickup truck, van, minivan, SUV, or motorcycle, and must weigh less than 14,000 pounds. This deduction phases out when modified AGI exceeds $100,000 for single filers or $200,000 for joint filers. The $10,000 annual deduction limit applies per taxable year, regardless of how many qualifying vehicle loans are taken. The following types of vehicle loans do not qualify for this deduction: loans to finance fleet sales, loans to purchase a vehicle used for commercial or business purposes, lease financing, loans to purchase a used vehicle or a vehicle with a salvage title, and loans to finance the purchase of a vehicle intended to be used for scrap or parts. California does not conform to no tax on car loan interest. You have now completed the 12th of 13 VITA training sessions. All sessions are available on the Franchise Tax Board website at ftb.ca.gov. Again, if you have any questions, please contact your local VITA coordinator. You may also reach out to FTB's team at 800-522-5665 or by email at volunteercoordinator@ftb.ca.gov. Keep practicing, and thanks for watching.